Hopefully, hopefully I'm the guy they call. But anyway, instead of buying that house, I ended up buying the house right next door, right here, and we'll go into that one. But anywho, folks, you get into something like this, whatever market you're in, you put 3.5% down. What happens? You are taking control of an asset with 95% of the bank's money. And if you can get a tenant in the future, after you live there and you fix it up, because you generally got to live there for a year first, which is not a big deal. I mean, you're paying rent to somebody, so stop paying rent to somebody, for goodness sakes. Anyway, get a place, lock it up, fix it up, live there for a year, move, and go do it again. That's called bank hacking, by the way. People are so obsessed with house hacking, which would be moving into like this 4-bedroom house, renting out the different rooms, and helping make your mortgage payment with that, right? Great method, great idea. But take advantage of bank hacking too. See, bank hacking is going to let you buy a place for 3.5%, 5% down, and then when you move, you do it again. And what's happening? You're acquiring massive real estate wealth over and over and over again, especially if you can buy them below market value, which usually when they need a little bit of work you can do, because there's this really weird thing in real estate, but people are really clueless when it comes to real estate about how much it costs to do paint and carpet and little stupid stuff that you could YouTube and figure out how to do yourself online. It's really kind of sad. People are clueless about that, but it's good because it creates an opportunity for you to build your wealth, because you can YouTube how to do that stuff. How to change an outlet, how to change a faucet. You can do a lot of this stuff, and that's phenomenal, because what are you waiting for? Buy a place, fix it up, do it, save some money, save every penny you can, like Lauren and I did, and build your wealth. You got to focus on what phase of life am I in? Am I growing my wealth or reducing my wealth and living off of it? If you're growing your wealth, you never pay off real estate. You get 30-year fixed rate mortgages, none of the variable rate stuff. That way, if rates end up going up because there's a bunch of money printing and inflation, you've locked in an interest rate for 30 years. They can't make you sell your house as long as the payment's getting made. Some people wonder, like, Evan, but what about mortgage insurance? And what if there's a slight negative or whatever? Folks, you get into something let's say you're buying in a $300,000 neighborhood, you get yourself a $450,000 house that needs, $20,000 worth of materials and your labor going into it, maybe the equivalent of 40K or whatever, or less, who knows? You just pocketed over $100,000 in equity. Who cares if you got to spend a couple $100 as a negative cash flow the first few years that you own it? Now, I'm not obviously advocating you get into negative cash flows. When I started buying real estate, I never had a negative cash flow. Nobody wants a negative cash flow. Hey, I'm just going to interject a quick little bit of clarity here. Let's say you buy a place for $300,000 and your payment, and I'm making this up because taxes are different everywhere, your total payment all in, principal, interest, taxes, and insurance, along with a little bit of fix-up money, because I usually like to set aside $100 a month per property, your total expenses are, let's say, $2,700. And let's say the market rent that you can get to get a high-quality tenant is $2,500. Because keep in mind, somebody will be more than willing to pay you $2,700, but they might not pay the rent. You never want to pay, or you never want to rent a place out for more than market value. Get market value, and then now you've got that $200 loss there, which once you get rid of mortgage insurance, that could go away. When you raise the rent $30, $50 a year, that'll eventually go away as market rents increase over time. But worst case scenario, you want to ask yourself, okay, can I afford a $200 negative? That's $2,400 per year. Based on your income, can you afford to basically invest $200 per month into that property? See, people make the mistake of thinking, I'm losing $200, but if you're getting a place under market value, you're actually paying more than that down in principal. You're getting the appreciation factor, the leverage factor, the piggy bank factor. You're getting so many benefits for that. And it'll also unlock the door for you to get into the next property. Plus, if you wanted to offset that negative, you could house hack that property. Really, the whole, oh my gosh, if I put 3% down, it's going to be slightly more expensive than what the rent is argument. Bad argument. Bad argument. Especially when you're trying to build your wealth. It's almost pay to play at this point. All right, let's keep going. Well, the point is, you got to get in to focus on building your wealth when you're in that wealth building phase. When you're in that payoff phase, that's when you really focus on switching. Okay, how can I take all the wealth I've generated and create as much passive income as I can? For example, I could sell my entire portfolio right now and just put it into AT&T stock, milk a 7 to 8% dividend, and do nothing ever for the rest of my life. I could sit around and just milk the wealth that I built. But I built the wealth because I clearly understood, okay, I'm going to start with the wealth building phase of life. I'm going to build my wealth as fast as humanly possible. And then as soon as I want to make the transition, I can easily transition over to passive income. Mortgage insurance, I should finish that one off really quickly with mortgage insurance. A lot of people ask me about that. Hey, Kevin, what about mortgage insurance? Look, when you buy a place and you put less than 20% down, that's called the cost of doing business. So what? You get mortgage insurance. Stay away from the offers that you get from lenders that's like, oh, but what about a no mortgage insurance deal? No. Stay away from that crap. You do not want a no mortgage insurance deal if you're putting less than 20% down, because usually they're just building that into your interest rate. It's a bad idea. Take mortgage insurance separately, separate line item, so that way, after you've lived in the place for a year and you fixed it up, you can call the bank up and go, yo, I want to refinance, and boom, you get rid of your mortgage insurance because now you got 20% equity. You buy a place for $300,000, you put 3% down, what's your loan going to be? Your loan's going to be like $190,000-ish, something like that, or $290,000, excuse me. If the place is worth $450 after you fixed it up, 20% down is $90, so that brings you down to $360. Pfft, you easily got, you got way more than 20% equity in the deal. So you'll easily be able to get rid of mortgage insurance. You don't even have to refinance. Can't qualify again, whatever, who cares? No problem. You end up calling up the bank going, hey, I want to remove my mortgage insurance. Done. That's how I started building my wealth, is I did exactly that with my real estate. And I really got to using the deals that I bought in real estate as little piggy banks, as opportunities for me to say, okay, I'm going to buy this property solely because I'm going to be able to generate wealth with this property because I'm buying it below market value. It's called buying a wedge deal. We talk about that obviously in my real estate investing course all the time. When you buy a deal like that, then you can refinance the deal. You know, it's like kind of like the Burr method we hear about. And then you can do it again. Repeat. The beauty about that is I now take money out of my first deal and I use that to go buy another deal, and I'm making bank by basically building my wealth over and over and over again. Oh my gosh, it's gonna crash, it's gonna crash. You never end up getting in. You never end up building wealth. So this is why we say, don't wait to buy real estate. Don't wait to start acquiring stocks and assets. Buy assets and stocks and then wait, which is kind of cool. They're all 30-year fixed rate loans that I'm getting. So that way, again, if the market's interest rates go up, I don't end up getting screwed. And the tenants are paying all my bills for me. When I take all of my income and all of my expenses on my properties, I'm not coming out of pocket to own all of the real estate that I own, which we'll touch on my portfolio in just a moment. We'll go through the thing. But what's beautiful is when I'm able to control so much real estate, I'm all about controlling real estate, when the market crashes like it did in March, I was able to, as I say, break the piggy bank. I refinanced 8 to 10 properties that I hadn't refinanced in a while. Usually I don't like refinancing, but I did in March, and I told all my course members, this is the time to refinance, get in before everybody else starts refinancing, which ended up happening. But anyway, and that was really predictable. I mean, rates fell so quickly. It's like, it was so, like Jack, my 5-year-old, would know that everybody's gonna go refinance. But anywho, the point is, okay, now I'm able to take wealth from real estate, throw it into the stock market, and I get tenants paying my debt, which lets me invest in the stock market, which means I'm able to take advantage of a market crash in the stock market with tenants paying the debt off for me. It's absolutely nuts. So when it comes to getting rich quick in America, you've got to understand the institutions that exist. And here are the basic ones. People think it's better to rent because they get flexibility and mobility. I'm thinking to myself, man, I'm going to think a little differently. I'm going to think like a pro on this instead of like a noob. When I think, oh, I might have to move, I think, great, I get to move, which means I get to bank hack more. It's all in that mindset shift. When I think about buying real estate, I think, I get to cost segregate this property and take some extra tax losses to where the income that I'm getting from my tenants, which is paying off my debt, is now tax sheltered. That's pretty cool. And I might never have to pay taxes on this real estate because if I want to sell this building, I could just 1031 exchange it, and then there's always a stepped up tax basis in the long-term future, which means I never ever have to pay taxes on real estate, which is something unique about real estate, that you could sell real estate and basically forever, perpetually prevent paying taxes, which is incredible. Anywho, for folks trying to build wealth quickly and get rich quick, kind of for that long term, I generally recommend buy your first place, get a fixer, fix it up, live there for a year, do it again. Do it again, do it again, do it again, do it again. Don't sell. Every time you sell, you take short-term gains, so you get taxed more on your short-term gains, and you end up giving away a massive amount of control of market share that you had. For example, if I took this property, if I put it on the market today, it'd probably sell for $740,000. I bought it for $600 even, and I probably spent about $40,000 onto it. So it's about $100,000. I'd have some, if I sold it, I'd have some selling expenses. I'd have to pay another realtor. I could represent myself, which is nice, but say 3% in expenses, $20-ish thousand. So I'd walk away with 700, 20-ish, so about $80,000 in profit. That's not bad. $80,000 in profit, that's not bad. Why don't I just flip it? Well, because I would now walk away with $80,000 plus the principal that I have in the property, which would be, minus my debt, would be another probably somewhere around $600, probably another $150,000. So I'd get about $230,000 in cash. Now, what can I do with that $230,000? Well, certainly I could just throw it into Tesla stock and do amazing. I could throw it into Bitcoin and do amazing. Those assets perform way better than real estate, at least have. We don't know if they consistently will. Real estate's like a slower moving giant, but it lets you get that leverage, right? You can't take $210,000 and throw it into Bitcoin and Tesla if you don't have $210,000 to throw it into Bitcoin or Tesla. That's why you buy that first place with 3.5% down, where you're putting 10 grand down to control a $300,000 property, so you're turning $10,000 into $100,000 of wealth. You're basically able to guarantee 10xing your money when you buy your first place. Then you do it again, you move, you bank hack, 10% down, 5% down, whatever, you 10x again, 10x again, 10x again. It's incredible. Like, building wealth through real estate is absolutely unbelievable. It's just when you get to a certain state, or a certain phase of life, I should say, a phase of real estate ownership, you kind of start wondering, why am I spending so much time doing real estate deals if I could just throw it into, again, recently, Bitcoin or Tesla? You don't need to throw that much time, effort, and energy into, I got to call the landscaper to come finish his job. I got to make sure that screw is added over there, or honestly, I could just forget about it. It's not that big of a deal. Whatever. We got to call the gas company because they're complaining or whatever. I just see the notice right there. I don't even know what it's for. I'll have to figure that out. Why bother? Well, when you're getting started, you bother because you build your wealth so fast. You get $80,000 by flipping this out of the way, or you don't flip it and you get 100 grand of value. Oh, beautiful. Why would you not do that? You build your wealth so freaking fast, especially as a home buyer. But I know if worst case scenario, things go really, really bad in stocks, I could probably sell or refinance a few properties. So why don't I take just sell this thing and take the $200,000 out of it and just YOLO it into Bitcoin now? Because it's my emergency fund. This is a big thing I talk about on my channel and in my courses is, this whole have a 6 to 10 month emergency fund and don't have any real estate debt. It's stupid because you're not going to get ahead. Not going to build your wealth in this country. If you have a job and you have the capability of working, you don't need a 6 to 10 month emergency fund. You are working, you have a job. If you're married, you've got 2 people working, so you have even more of an emergency fund. The better thing you could do is try to figure out how could you get a better job to make more money. That would be much better. You can get a better job, you can qualify for more real estate, which is even more phenomenal. So now, if I add all of this up, I have a total of, and this sounds insane, okay? This is like, holy crap, that's a lot. I have $12.2 million in debt on about what will be worth about once this last renovation is done, what'll be worth about $22 million in real estate. So that puts me right around, what is that, like 60% debt or something like that? That's actually not bad for real estate. That's pretty good. Yeah, I mean, the cash flow will be very nicely present once all these renovations are. Just to add that together, that means we get to a total of, from yesterday's video, $20.59 million in stocks, minus $4.951 million in debt, plus $22 million in real estate, minus $12.279 million in debt. That comes out to a net position of right around $25.3 million after all debt. This is pretty incredible. That's pretty insane, I have to say. Wow, okay. The thing about real estate is it's very fast to start your real estate portfolio, especially when you get your first and second wedge deal. and it's really hard to start your stock portfolio. This is why I always recommend start with real estate. But then you could start growing both together. So there it is. That's my real estate journey. Thank you so very much for watching this. Hopefully you learned something. Thank you so much for seeing the breakdown of the portfolio. Now you know the breakdown of both portfolios. And folks, share the video if you found it helpful, subscribe, and we'll see you in the next video.